Now, ladies and gentlemen, welcome to this third session. You're now watching the G20 Global Financial Stability Conference. And in the third session, we're joined by 5 experts and government officials that will share discussions regarding a post-pandemic international financial market and system. In this session, Mr. Mingqi Xu, the professor and PH.D., advisor of Shanghai Academy of Social Sciences, will take over as the moderator. We'll also be connected through Zoom. Mingqi Xu, the professor, hello.
Hello.
Hi, how are you? Thank you very much for joining us today.
Good afternoon. Yes, everyone.
So, shall we begin?
Yes, I think so.
So, please
Can you hear me?
start the session. Yes.
Okay. Thank you for inviting me to be the moderator of session 3. And this session, the title is Post-Pandemic International Financial Market and System. Although I'm not quite sure we have already overcome the pandemic of COVID-19 with vaccination and a lot of measures have been taken. Fear for this COVID-19 is gradually increasing. The economy is open, and the world economy is recovering, although with a lot of potential risks. So this was at this point discuss the international financial market and the system, and their stability and potential risk, and what kind of the measure we need to take. So we have 2 well-known and distinguished scholars as this session's speaker, and also another 2 very respected scholar as the panelist discuss this topic. And first one of the speaker is Professor Shin, and he is a well-known scholar at the international finance and monetary economics. And he graduated from Oxford University with PH.D. degrees. And after that, he has been teaching in many well-known universities, including this London School of Economics, and also, Princeton University. He was the professor of chair of the professor in the Princeton University. And now he's the director of the research department at Bank of International Settlement. And we have the second speaker is Dr. Mesnard, Mesnard, and he or she is acting director for the financial and enterprise affairs, and she graduated in well-known French university and research institutions with both degrees in MBA, marketing and business, and also economics. I think she's now working in OECD as the director for financial and enterprise affairs. Before that, she worked for many positions in OECD. And we have 2 panelists. The first panelist is Dr. Catherine Mann. I think she's also well known, and she's now the member of Monetary Policy Committee of Bank of England, and she was the chief economist at OECD, and also worked for Citibank for a while. and she served also in the Citibank as the financial analyst, and she also worked in the Peterson Institute for International Economics. She is, distinguished, well-known international economist. And we have another panelist, that is Soyoung Kim, professor at the Seoul National University. Soyoung Kim graduated from Yale University, I think. He has been teaching in many universities, like University of Illinois in the United States. Now he's the professor of the Seoul National University, top university in Korea. So now I think I'm going to give the floor to the first speaker, Professor Hong Song-Shin. Please.
Thank you very much. It's a great pleasure to join you on this distinguished panel. I'd like to say a few words on the post-COVID financial landscape and try to learn some lessons on the changing nature of financial vulnerability that were shown during the pandemic. And here I'd like to follow one theme, which is on the transition from what you may see as the traditional model of financial vulnerability of an Asian emerging market economy, very much inspired by the Asian financial crisis and the features seen there. It's very much a borrower perspective, and the two vulnerabilities have to do with the currency mismatch and the maturity mismatch. What I'd like to do today is to lay out a number of themes which I think is a new perspective, the elements from the capital markets, and they present a different perspective on the nature of external vulnerability. And it's more of a creditor perspective, but something that is due to the hedging needs from the FX market that is due to the currency mismatch of the external asset portfolio. And one of the themes that runs through this particular topic is the importance of non-bank financial intermediaries. So if we put this into long-term context, I think one important background fact is the demographics, which globally has seen a fairly rapid aging, with the importance of funded financial institutions, pension funds and insurance companies, whose assets have grown very rapidly over the last 20 years. So here are the financial assets of pension funds and insurance companies. And they've been very large even as a percentage of GDP. So if we look at the debt securities of pension funds and insurance companies, they started 20 years ago at around, on the left-hand panel, around 12%, and now over 18%. Similarly, for insurance companies, they pretty much doubled as a proportion of GDP. We can also look at the currency composition of the external portfolio. And here I'm showing the IMF CPIS data, the Coordinated Portfolio Investment Survey, of the external asset portfolio, firstly of the debt securities on the left-hand panel, and of the equity holdings on the right-hand panel, arranged according to the currency. And here the blue is the part in yen, but the pink here is in US dollars and in other, and the yellow and the gray are in euros and in other foreign currencies. These are very large numbers, as you can see, but here is another example of Switzerland. Here, the brown part is the amount held in Swiss francs, but again, the pink part in US dollars looms very large. In the case of Korea, the start has been very small, but there has been a fairly rapid increase both in the debt securities holdings, but in particular the equity holdings. And as you see from this chart, both for the debt securities and for the equities, most of the external portfolio has been in US dollars. If you look at the scale, we're talking about something in the region of $200 to $300 billion. In other Asian countries, there's been a similar trend, and here I've given you the example of Thailand. Thailand has a smaller portfolio, as you can see. It's around 1/10 the size, but the trend is very similar, and it's also of a similar composition. And here are some other examples of Malaysia and of Indonesia and Philippines. Now, the issue here is how do we have the external portfolio, but then fulfill the obligations to the domestic policyholders and to the domestic beneficiaries, because those obligations are in domestic currency. So there has to be some way of hedging the external portfolio, and typically this is done through the foreign exchange market, either through forwards or through the swap market. And in aggregate, if we look at the global aggregates, one way of tracking the aggregate hedging activity is through the BIS data on FX swaps and forwards. And the left-hand panel gives you the global aggregate. So you can see that these are very large numbers of tens of trillions of US dollars. And if you know the BIS data, these numbers are arranged according to the counterparty. So these data are collected from the dealer banks, and they're arranged according to whether the FX swap is taken on by non-dealer financial firms, dealer financial firms, so dealer to dealer in blue, or non-financials. And you see that the biggest component has been the non-dealer financial institutions that have taken out the FX swaps and forwards. And I have set this side by side with the CPIS portfolio series on the right-hand panel. And you see that when arranged according to the same scale, the aggregate hedging activity very closely mirrors the aggregate external portfolio. So here the blue, the debt securities, and the pink is the equity series. And when we look at the role of the non-financials, and here the left-hand panel is all sectors and how much of it is non-financials, here on the right-hand panel, we see that the non-financials are very small compared to the financials. In other words, most of the hedging activity can be attributed to the activity of financial institutions. And the story very much that emerges from this type of data is that the FX swaps and forward activity can be attributed very much to the long-term institutional investors globally. And among that, the investors from emerging markets have become increasingly important as their footprint in the international financial markets have also grown. So here's an example of 5 Asian currencies. So I've highlighted them in yellow: Indonesia, Korea, Malaysia, Philippines, and Thailand. And if you look at the axis, you can see that we're talking about numbers ranging up to $1.5 trillion US dollars. And over the last 10 or 15 years, the hedging activity of these Asian countries have really grown. There are some details on the footnote which I will not have time to go in. We conduct the triennial survey every 3 years, but that's supplemented by the semi-annual survey every 6 months. But the broad trend gives you a sense of the rapid growth. Now, one of the interesting insights that the hedging activity gives is how we can think about the yields that are available to investors with or without hedging. So one very typical example would be this kind of chart, which is just the raw 10-year government bond yields in black in the US and in a number of other countries. And we see that the most recent period, we've seen some turbulence with the pandemic. But the raw yields give a misleading picture of the amount that investors are able to secure on a hedge basis. So with currency hedging, how much could you earn on a 10-year US treasury bill when you have to pay the hedging cost? And the hedging cost here is the forward rate that comes from the swap contract. And here is the picture. Imagine that you're buying 10-year US treasuries, but then hedging back those returns to euros, yen, and to Korean won using 1-year rolling hedges. So you take out 1-year swaps and then you roll over as the swap matures. And you see that the yields are much more closely aligned on the right-hand side. And the differences here reflect very much the short-term yields, because the 1-year hedge is very much the difference in the 1-year yields across these economies. And you see that the yields are much closer together. And I think one picture that emerges is, even though domestically the yields in Europe and Japan may be much lower than the US, you can secure a higher yield if you hedge it back while buying US treasuries. And the same is true of Korea. Now, one of the issues that comes from this greater hedging activity is that the counterparty is typically a dealer bank, which means that the dealer bank has to lend you dollars, but then has to source the dollars in the global capital markets. Now, one of the benchmark results in international finance is covered interest parity, which says that the interest rate that is implicit in the foreign exchange market for US dollars should equalize to the interest rates in the money market for US dollars. So if we look at the difference between the money market rate in dollars and the money market rate in Korean won, that should exactly mirror the forward rates in the swap market. Now, typically, typically before the Great Financial Crisis, covered interest parity held very closely. But since then, we have seen a divergence. And typically, the FX implied dollar interest rate has been higher than the money market implied dollar interest rate. And the difference is known as the FX basis. And that is an indication of the tightness in dollar funding conditions. And the FX basis is typically measured as a difference between the money market rate and the FX implied rate, which means that the FX basis is typically negative. So here is an example of what happened last year during March, when the FX basis of the US dollar vis-a-vis the euro, the yen, sterling, Swiss franc, and the Korean won started off negative, but relatively close to zero. But then we had very sharp dollar funding pressures as the COVID crisis really took off. And you see that for the Korean won, the FX basis grew very large indeed, very close to 300 basis points. And it was on March 15th when the Federal Reserve announced the enhanced swap lines between the Fed and 5 central banks that we had the gap closing. Now, if we look at the longer term, one of the very robust findings is that the FX basis is very much tracked by the strength of the US dollar, to the extent that the US dollar is an indicator of the tightness of dollar funding conditions. So here, the blue line is an average of the FX basis for all these countries, all these currencies that I've highlighted in yellow. And there you have to look at the right-hand axis, and that's measured in basis points. The red line is the broad US dollar index. And when the red line goes up, that means it's a stronger dollar. So as we see here, last March, we saw a very sharply stronger dollar, and that coincided with this very sharp broadening. very sharp widening of the FX basis. And you see from this chart that there is this reflected symmetry between the strength of the dollar and the width of the FX basis. If we look at the individual currencies, and this is going back to 2006, and here the light blue line is the FX basis for the Korean won, we see that during the great financial crisis, we saw a great deal of stress in the dollar funding market in Korea, seen by the very large FX basis in the blue line. The dollar stresses were broad-based, but you see that it was especially severe for the Korean won and a number of other Asian currencies. And although these stresses have become smaller over time, we see that last March, so here I'm just going to show you, here we see the events of last March, that we again saw a widening, but of course by nowhere near the same magnitudes as during the great financial crisis. But some of the emerging Asian currencies were more susceptible to this type of dollar funding stresses. So what this shows is a changing nature of the dollar funding vulnerability. It's no longer a borrower perspective. It is very much a creditor perspective. These dollar funding stresses are also seen in advanced economies. And to that extent, what we saw in Korea is an instance of the changing nature of dollar funding vulnerabilities that share some of the same attributes as the stresses that affect creditor economies, and that due to the hedging demands of the external portfolio. But it's useful to bear in mind that the same types of dollar funding stresses that affect the supply of hedging services are also visible in global liquidity conditions more generally. So the influence of the broad dollar index in determining global credit conditions is also seen in this chart, which is the global year-on-year growth rates of dollar credit to emerging market economies, which here is shown in red, which fluctuate very closely with the changes in the broad dollar index, which is here shown by the solid black line. Now, what this means is that we have to think about the broader policy issues and the macro-prudential backdrop in the context of the global liquidity conditions very much affecting the availability of credit and dollar funding conditions more broadly. As you know, the IMF has been working on the integrated policy framework, which envisages a complementary role for macroprudential frameworks, FX intervention, and capital flow management policies to complement with monetary policy and other macro policies. We at the BIS have also been busy working on very similar issues. We call it the macro financial stability frameworks. And we've been working with our member central banks in rolling out a number of practical and well thought out, we think, frameworks to tackle some of these external issues as a complement to the monetary policy frameworks in our member central banks. And we recently published a report among the Asian Consultative Council of the BIS member central banks in Asia last year. And earlier this year, we published a similar report from the Consultative Council for the Americas, consisting of our member central banks in the Americas. So I think this is one area where the G20 has a very important role. Traditionally, the IFA working group has been a very good forum to compare notes on these issues. And I think this is also very appropriate that we have this session here today. So let me finish there, Professor Xu.
Thank you, Mr. Shin. I think his presentation, it's very variable because we see in the last global financial crisis and this time, pandemic shock and dollar supply stress, caused, these assets return in the market, and also quite kind of similar, not only, in the type of the quality of these phenomena, but also in the scale. So I think the Federal Reserve quickly, respond to this dollar supply stress with central bank swaps and also non-limited QE supply US dollar. I think that have some good impact on the financial market. But of course, if later on these sort of things happen again, I think central banks coordination and the cooperation and some formal mechanism also needed. Now I think I'm going to give the floor to the second speaker, please. Miss.
Thank you very much. Yes, dear colleagues, it's really my pleasure and very honored to represent the OECD together with other colleagues, because I saw Caroline Malcolm talking in the previous session. So to represent the OECD for this year's G20 Global Financial Stability Conference. And I would like to express my thanks also to the Korea's Ministry of Economic and Finance and the Korea Development Institute for the invitation. So as many colleagues before have noted, the COVID-19 pandemic is the kind of crisis we only see once in a generation. Even if our generation, we have seen already a couple of crises. And the challenges that we face only underscore the need for more collective and meaningful cooperation. So could you get to slide 3, please? And so thanks to, next one, please. Next one, thank you. So thanks to global and coordinated action, including through the G20, we are seeing signs of hope almost 2 years after the beginning of the pandemic. And with vaccinations, with better health management, but also with unprecedented fiscal and monetary support, that have led to further strengthening of the growth outlook. Our OECD, economic outlook that Catherine Mann knows very well, and that was released in June this year, projects a strong rebound in 2021, with global GDP expected to increase by almost 6%, and the fastest in somehow 50 years, and 4.4% in 2022. So we are about to release our new interim economic outlook projections, but they are not yet ready. Next slide, please. But what is very certain is that the uncertainty remains high. The recovery is quite uneven, that's for sure, and the virus remains the highest risk, short-term social and economic risk. So in my remarks today, I will focus on the implications of the COVID-19 crisis on the international financial system and considerations for policy actions to ensure a sustainable and resilient recovery. And while the phrase may be perhaps overused, we must do our best to build back better. So I will first revisit some of the structural weaknesses that burden us going into the crisis. And these weaknesses require careful and strategic consideration. And then I will propose some considerations for next steps, maybe many of which are already on the global agenda of the G20 and indicated also in domestic recovery plans. So in terms of pre-pandemic structural weaknesses, as our Secretary General highlighted to finance ministers and central bank governors at their meeting in Venice in July, we entered into the COVID-19 crisis with a number of structural weaknesses that now limit our ability to rev up our economic engines towards a sustainable path to recovery. Many of our economies were indeed struggling before the crisis with slow productivity growth, with declining business dynamism and persistent long-term unemployment or informality, as well as unequal opportunities. So what I would like to highlight here are two specific areas that, if they are left unaddressed, will undermine efforts to exit government support and to pivot towards recovery. And these include rising levels of sovereign debt and record high levels of corporate debt. So could you go to slide 6, please? In terms of sovereign, 6, I don't know. Slide 6, yeah. In terms of sovereign debt, according to data from our sovereign borrowing outlook that we published in May this year, the effects and the responses to the COVID-19 pandemic pushed sovereign borrowing in OECD countries to a record high last year, exceeding $18 trillion and up 60% compared to the previous year. Could you go to the next slide, please? And governments are expected to borrow at slightly above these levels again in 2021. So this expansion in debt has been facilitated by the low cost of borrowing, and nearly 80% of fixed rate government bonds were issued with less than 1% yield in 2020 in OECD countries, compared to 37% in 2019. And this has been due in large part to, of course, aggressive policy easing from central banks, which have become the single largest creditor in the majority of OECD countries. This debt, which was, of course, a necessary part of the crisis response, so don't get me wrong here, this debt has been a lifeline to many businesses. The financing support programs introduced by governments following the outbreak of the pandemic have helped affected companies manage sharply deteriorated operating cash flows and short-term liquidity shortages to avoid widespread insolvencies. But, of course, they were necessary, but we must be cognizant of and also address definitely the resulting risks. And because we see that over 40% of this unprecedented amount of sovereign debt is due over the next 3 years, during the very period that interest rates and cost of financing are expected to normalize from very low levels. And as a result, the overall level of debt across sovereign corporates and even households to GDP is at unprecedented levels in many OECD countries. So the situation with developing and low-income countries is even more acute. Debt servicing challenges could result in decisions to put immediate repayments over critical health needs of societies, vital support to struggling businesses, or underlying challenges of preserving natural capital. And the scale of financing needs could have major implications for current and for future debt sustainability. And several emerging market and middle-income countries face immediate challenges in accessing finance. Next slide, please. Another major source of current financial vulnerability derives from the rise in global corporate debt in both advanced and emerging economies, resulting from low interest rates and abundant liquidity. Highly accommodative monetary policy of major central banks have contributed to boost investors' hand for yield in a very low interest rate environment since the global financial crisis, that have facilitated low-rated issuers to increase their leverage at a relatively low cost. So unprecedented monetary and fiscal support following the COVID-19 crisis have even contributed to exacerbate these trends. According to OECD data released in our June 2021 report called The Future of Corporate Governance in Capital Markets following the COVID-19 crisis, we see that the issuance of corporate bonds globally by non-financial companies hit a record level in 2020 at $2.9 trillion, with the global outstanding stock of non-financial corporate bonds reaching a record of $14.8 trillion. And we have also seen a concerning decline in the quality of this debt. The share of BBB rated bonds reached 52% of all investment grade issuance over the past 3 years, up from 39% during the 2000-2007 period. At the same time, we have seen a rebound in the issuance of leveraged loans and collateralized loan obligations, now well over $2 trillion US dollars globally. And these loans have been largely issued without financial covenants that typically protect leveraged lenders from excessive losses. And furthermore, a significant amount of speculative bonds and leveraged loans are held in open-ended investment funds. These trends, which of course predate the crisis, but were exacerbated by the pandemic, these trends are extremely worrisome. High levels of leverage increase firms' vulnerability to shocks, obviously, the more so in a low growth environment. And the current stock of outstanding corporate bonds has lower overall credit quality, higher payback requirements, longer maturities, and inferior covenant protection. And these characteristics could amplify the negative effects of any downturn on the financial sector and the overall economy. Open-ended funds now also hold a lot more of the corporate debt than before the global financial crisis. So any sudden deteriorations in credit performance could contribute to sharp outflows and spillovers. And the combination of corporate leverage and liquidity transformation of funds could add to systemic fragility during periods of stress, as we are experiencing today. As a result of these trends, many economies, and especially emerging markets, will be facing limited fiscal and monetary policy space to further support business solvency in a protracted crisis. And we are actually seeing a rise in defaults in emerging markets. These risks contribute to a difficult balancing act for governments as they plan their exits from government support. And the unintended consequences of the stimulus has further increased indebtedness while shortening average maturities and heightening refinancing risk during exit from stimulus. So managing this path to exit to maintain growth while not giving risk to rise to systemic risks will be a critical task for policymakers. If you could go to the next slide, please. So what have been the lessons learned from the crisis? With these structural elements in mind, I would now like to focus on some of the lessons we have learned from this COVID-19 crisis. Governments have made significant and globally coordinated, importantly, efforts to address the consequences of the crisis, in addition to efforts over the past decade to improve the resilience of the global financial system. Yet, these economic shocks has illustrated that additional policy measures based on new ways of considering systemic risks, be they pandemic or climate change, are urgently needed to ensure a truly resilient financial system that leads to sustainable growth. And here, according to the OECD, are a few thoughts on what has worked in our collective response to the crisis. First, unprecedented monetary and fiscal stimulus that both addressed the acute stress in funding markets and also direct financial support to the real economy. As I mentioned before, this support has mitigated some of the worst case risk scenarios we were forecasting at the start of the crisis. Second, a comprehensive approach that spanned well beyond the existing crisis playbook to include targeted facilities to businesses, direct cash support to households, and more innovative ways to use monetary policy to ensure financing was broadly available. And third, while a number of emerging and advanced economies faced dramatic sudden stops in portfolio inflows during the first month of COVID, there was limited reintroduction of capital controls to stem these outflows. In fact, OECD data shows that instead, countries preferred to ease controls on inflows and foreign exchange measures to relax liquidity constraints. And that's what you can see on the chart in the slide. And lastly, and importantly, a high level of global coordination and communication at the international level, including with the FSB and in the G20, as well as the OECD with our communities of expertise. So let me now go to the considerations for the way forward. And could you go to next slide, please? So building on these lessons learned, I'd like to conclude my remarks with some considerations for the way forward for the post-pandemic international financial market and financial system. As I mentioned at the start of my intervention, we are not out of the woods, clearly, and it was mentioned by the moderator also, both in getting to an economic restart underwritten by widespread vaccination and in unwinding the unprecedented interventions that have held up the market over the past 18 months. So the confluence of elevated market valuations, excessive corporate leverage, as I mentioned, and growing interconnectedness has created conditions for a very fragile recovery that remains highly dependent upon unprecedented monetary and fiscal policies. So I would like to offer 3 considerations to reduce the danger that as we move toward a recovery and plan for an exit from government support programs, the materialization of risk does not undermine our efforts. First, governments need to ensure that greater use of equity injections is part of their crisis toolkit to support businesses. And based on our assessment, the unprecedented stimulus programs implemented to date have failed to adequately include equity programs and have increased indebtedness. Therefore, it's critical that government provide additional equity and incentivize businesses to tap equity through public and private markets well before exit occurs. Businesses may find post-exit market conditions much less tolerant of downside risks. Second, improvement to insolvency regimes are needed, badly needed in many countries, and should allow for more pre-insolvency flexibility, such as moratorium payment of liabilities throughout the crisis, and facilitate out-of-court procedures and debt equity swaps. And also with the prospect of rising bank non-performing loans, particularly in parts of Europe, authorities need to re-engage to consider how to resolve this comprehensively, including through market-based mechanisms, such as national and supranational asset disposal vehicles that can bring transparency, expertise, and liquidity to non-performing loans markets. This will be needed to cleanse bank balance sheets, and help restore banks' capacity to intermediate and support the recovery. If you could go to next slide. And of course, we need a particular focus on the resilience and sustainability. In the medium to longer term, there are also implications of climate change for markets resilience and financial stability. These implications include both physical risks related to the actual or expected economic cost of a continuation in climate change, and transition risks related to an adjustment towards a low carbon economy. So improving market resilience and policy certainty is vital to help mitigate the unexpected and anticipated impacts for physical and transition risks. And financial markets are de facto already moving in this direction. Policymakers must consider the full range of environmental risks that are more likely to threaten financial stability beyond the current crisis. And at the OECD, we are heartened to see governments taking concrete actions to build resilience and environmental sustainability. The pandemic saw important moves on health policy coverage, while almost all OECD and many non-OECD countries have now committed to net zero emission targets by around mid-21st century. And sustainable finance through environmental, social, and governance investing and green markets is providing a wealth of information that can help market participants and regulators better assess the potential climate risks and take mitigation actions. So to better align market objectives with our shared sustainability objectives, however, we need greater transparency, we need greater consistency, and greater comparability of metrics and of methodologies in order to ensure that investors have reliable market tools to facilitate an effective transition to low carbon economies. And here again, there is a need for greater cooperation and collaboration across borders and the public and private sectors to improve ESG disclosure, to improve data availability, to improve metrics and methodologies in climate-related risk, but well beyond into the other areas of ESG. And to our view, this cooperation should address 4 key priority actions. First is to mobilize the global governance system towards a mandated, auditable ESG data reporting framework to drive better transparency and standardization of core elements of ESG disclosure. Second is strengthening the environment, including through regulatory guidance on data disclosure, appropriate labeling of ESG products to ensure their link to materiality is clear, and defining long-term financial materiality to better capture slower moving environmental and social risks. And third is for governments to be modeling better ESG practices and data disclosures into their own businesses, for example, as enterprise owners, as customers and infrastructure investors. Finally, we should not seek to reinvent the wheel, and there are existing policy standards and industry practices that could already improve outcomes if fully implemented and form a good basis for future metrics, including, of course, at the OECD. So at the OECD, we stand ready to continue to support the G20 in its effort to align global efforts on sustainable finance through the Sustainable Finance Working Group and its roadmap. With our members and in collaboration with partners, including the G20 Sustainable Finance Working Group, the Network for Greening the Financial System, the IFRS Foundation, and the FSB, the OECD aims to develop a high-level ESG risk policy framework. This framework would aim to support international efforts and help drive coherence, bringing together and elevating existing guidance and standards on financial and non-financial reporting, corporate governance, and due diligence as reference points for reporting standards. So with these final reflections on how to build up a more resilient financial system, I'd like to thank you all for your attention and reaffirm the OECD's commitment to continuing to support you and the G20 in supporting a resilient and sustainable post-pandemic recovery. Thank you for your attention.
Thank you, Dr. Mesnard. I think she gives us quite, considerate and I think enlightening, kind of prospect of the world economy. On the one side, it's recovering, growth prospect is improving. However, risk is also accumulating, especially the debt ratio. Both government and corporate sector are accumulating huge amount of debt. And how to deal with this potential risk when the economy is growing, is recovering, and stimulating policy should exit from the stimulating. And these potential risks should be, in the policy consideration, and also, how to, enhance the international cooperation. And she also provide some policy proposals. I think these things, these policy proposals need to be, discussed later. And now we turn to our 2 panelists discussion. First is Dr. Catherine Mann. Please, Dr. Mann, I will give you the floor to you. Yeah.
Well, thank you very much. Thank you very much for giving me the opportunity to join this session. It's a wide-ranging session in terms of the topics that are.
Right. You have raised very interesting, very important 2 issues. One is dollar liquidity supply mechanism when the international financial market had a kind of external shock. And the second one is very also important, the domestic financial market stability. How one country's central bank and authority, financial authority could, maintain its stability. And for the emerging market, it's very difficult because, as what you said, that 74% is coming from a global market condition. So G20 and some other international platform for financial cooperation and coordination becomes more important. Global financial governance becoming more important, and especially countries, of these international monetary, function, like euro, like US dollar, now Japanese yen, and to some extent Chinese yuan also play some part of the international currency role and need to come together to have real good policy coordination. So now I will turn to the floor for our second panelist, Professor Kim, Soyoung Kim, please.
Thank you. Good afternoon. First, I'd like to thank the organizer for the invitation to this nice conference. Dr. Mesnard provided a great presentation on COVID-19 and international financial system. And Dr. Mesnard covered various issues, including pre-COVID challenges, and what we did and what we can do further based on our previous crisis experience. And I mostly agree with the various points raised by her. And here I would like to add some more thoughts, mostly on phasing our strategy for a post-COVID recovery after huge expansion of macro policies under COVID-19. And I also would like to add some thoughts on international spillover effects from large advanced economies to other countries, for example, emerging countries, when large advanced countries tighten macro policies after COVID-19. So first, I would like to say that current economic situation is very challenging. We have a bigger challenge this time than during the global financial crisis. First, almost all countries are directly affected by COVID-19, and this is quite different from GFC. During the global financial crisis, many countries suffered, but some countries suffered from international spillover effect from advanced countries, not from the direct effect. And second, most countries take more expansion this time than during the GFC. This means that normalization will take more efforts this time compared to the GFC. And third, there are more uncertainties this time than during the GFC. It is very difficult to predict how COVID-19 would evolve in the future and how seriously COVID-19 would affect our economy in the future. And fourth, there are huge asymmetries on the effects of COVID-19. The effects of COVID-19 on various sectors within a country are quite different. For example, COVID-19 has a huge effect on service sector, but less effect on manufacturing sector. In addition, the effects of COVID-19 are quite different across countries. Some countries experience huge recession, but others do not. And fifth, nowadays we have more financial integration between advanced and emerging countries. So we expect more financial spillovers from advanced countries to emerging countries. Then let me briefly look at more details on policies and consequences during COVID-19. First, all countries have taken huge monetary expansion. QE has been widely used this time, and even some emerging countries have used QE this time. And the size of expansion is larger than before, and more tools are used than before. As a result, we have a huge liquidity and private debt. We have a huge household debt in addition to corporate debt. And also we observe inflationary pressure and asset price inflation. And fiscal policy have been also quite expansionary. We have more expansion than before. As a result, we piled up huge government debts. And this is not the end, and it's very likely that we further need a COVID-19 rescue program during a post-COVID recovery. And we expect that some households and firms will be insolvent later. And as the economy recovers, we need to tighten various policies. First, we need monetary policy tightening. This is to slow down excessive credit expansion and inflationary pressure and asset price inflation. And second, probably not now, but at some point in the future, we also need fiscal contraction. Otherwise, we would have a sovereign default problem. And third, macroprudential tightening may also be needed. This is to slow down excessive credit expansion. Then, when large advanced countries tighten macro policies, this would have a substantial effects on other countries, including emerging countries. This could lead to a huge increase in volatility in capital flows, sudden stops, and financial turmoil. And this type of international spillover effects would also be far larger than before. First, tapering of monetary policy of large advanced countries would have a larger effects on emerging countries than before. Again, the size of the expansion was larger than before, and international financial linkages between emerging and advanced countries are stronger than before. In addition, the recovery is asymmetric. Recovery of emerging and developing countries have been slower than that of advanced countries. So when already recovered advanced countries tighten, emerging and developed countries would have a hard time. They are not fully recovered. And on top of it, they would have a bad spillover effects. And we mostly care about the monetary the international spillover effect of monetary tightening, but we can also think of fiscal contraction. Of course, fiscal contraction will take some time, but eventually many countries will take a fiscal contraction. And this may also have an important spillover effect to emerging and developing countries, given the size of huge fiscal contraction. And another policy we have not really considered much was macroprudential policy. So macroprudential tightening may also have an international spillover effect. And this is actually quite challenging issue because we don't really know about international spillover effect on macroprudential policies. To summarize, this time normalization of macro policies would be far more challenging than before. This is even more challenging for emerging and developing countries. They have their own normalization issue. In addition, they would experience huge and uncertain spillover effects from advanced countries. A very good news is that global financial safety nets are stronger than before. So we have continued to develop it from long before global financial crisis. Still, we are not really sure whether current level of global financial safety nets are strong enough. So therefore, as we recover from COVID-19, we need very careful monitoring on international spillover effect and international financial markets. We also need to develop a proper way of international policy coordination this time, which may be quite different from what we did before. Let me stop here. Thank you.
Okay. Thank you, Professor Kim. I think he basically mentioned this challenge we are facing today after historical high volume and quantitative easing and expansionary physical policy adopted by almost every country. Now we are facing the result, the negative effect. That is the asset doubling and also inflation. And how do we deal with it? And he tried to provide some policy recommendation and to consider the potential risk. And when phasing out of these expansionary policy, and we need to carefully design policy and also the procedural and step-by-step, and also international coordination is very important. I think that's very important policy advice. So now I think we have finished 2 speakers and 2 panelists presentation, and we entered into a kind of a Q&A. Okay. So because Dr. Mesnard has a bilateral meeting with the minister, so she has to leave the panel. So, question. Actually, there is a question for you. Do you have any time, a little bit time to answer this question?
1 minute. Sorry.
1 minute. Okay. So this question is about. It's like this: what are the suitable financial policy scenario for the startup business during and after pandemic? This question is pointed to you and hope you to answer.
The
suitable financial policy scenario for the startup business.
For startups.
Yeah.
Wow. I think to make sure that you have access to equity markets, public or private equity markets, and I think that's even, as I mentioned in my intervention, all the support to businesses during the crisis has been focused mostly on access to credit or liquidity. But our main point during this crisis has been to ensure that companies, be them startups or bigger ones, do tap properly the equity markets. So that would be a very, very broad answer. I'm sorry, very broad and quick answer.
Okay, thank you. Because she has to leave, so I think we continue our discussion and Q&A without her. Okay, you can attend the meeting with your minister. So now, is there any question in the floor in Korea, in the meeting room in Korea? Any question?
Okay, I'm here. So, is there any questions I'd like to ask all the participants from the floor? I'd like to ask the questions from the floor instead of the Professor Mingqi Xu. So because he can't hear and he can't see the floor on site.
Yes.
So is there, okay, we have a gentleman here who would like to pass off the microphone.
Okay.
And would you please introduce yourself briefly and also give your question? So the professor, you can hear me?
Yes.
하면 되나요?
Okay.
Okay. Thank you so much. I really appreciate for distinguished participants, remarkable and insightful thoughts about this, the topics. Actually, with respect to the capital floor, it is related with the first session, but I really appreciate even session 3 deals with these very important topics. My question it might go to Dr. Shin or Dr. Kim regarding the coherence between international standards regarding capital floors. As you know, there are the IMF's institutional view regarding capital floors, and also there is another very important standard managed by the OECD, the Code of Liberalization. But there are some discussion about the coherence between two standards because IMF institution is very flexible about responding to capital floors for the emerging market perspective. But in case of OECD capital code, it's more conservative about implementing capital floor management measure management. But in order to avoid the confusion for developing markets, I think there is some need to develop coherence between two standards. Regarding this perspective, I really want to listen the comments from the Dr. Shin as well as Dr. Kim. Thank you.
Okay. Shin?
So would you please reply about that question, Dr. Shin and Dr. Kim?
Let me start, and then I can hand over the floor to the other panelists. As I said in my final slide, I think there has been some development in the thinking behind the link between the macro and the financial aspects of policy. And I think those debates are being now reflected in the policy advice given by the international institutions. Certainly the IMF has been at the forefront, and also at the BIS we have also worked very closely in step with the latest thinking. And I think it's a reflection of some of the things that Catherine also mentioned, and thank you, Catherine, for the very good discussion that you gave. And I think it's a reflection of the of both, the changes in the mechanisms, but also in the specific, policy tools that could address some of these issues. I think the important point is that we have a broad, holistic view of the of some of the policy challenges that that may arise. So let me stop there.
Okay, thank you, Dr. Shin. Professor Kim, do you have anything to say?
Actually, Professor Shin, Dr. Shin gave a great answer, so fine, yeah.
Okay, so I think if there is no more questions, I will stop. I will phase out this session. Thank you, all the participants and the speakers, especially Professor Shin and Mesnard already gone, and also Professor Kim. And Dr. Catherine Mann also need to leave. So thank you for all the participants and all the discussion. Thank you again.
Thank you. We need another big round of applause for the moderator and all participants for this session 3. Thank you very much. And especially thank you very much, the moderator, for leading the lively discussion panel. Thank you very much. And I'm afraid of that it has come to the end of today's all programs for today's conference. And I would like to sincerely thank all of our foreign speakers and our on-site speakers, and who have logged on to Zoom from the other side of the world as well to share useful information. And also our moderators today for leading the session, and our online and offline participants for sharing many opinions and attending until the very end of today's conference. Thank you very much once again. And next year's conference, we look forward to see everyone again face to face to talk about stabilizing the international financial market after the end of COVID-19. Then I'll be making my farewell here. We conclude all programs for the G20 Global Financial Stability Conference 2021. Thank you very much once again. See you next year. Bye-bye. 감사합니다.